Hello and welcome to Market Week in Review for the week ending January 12th, 2024. I'm your host, Michelle Bajargal, and today I'm joined by our investment strategist, Bei Chen Lin. Bei Chen, welcome.
Thanks, Michelle. Happy to be here.
Thank you for joining us in. Well, let's start with topic of recession. Coming into last year, 2023, we had strong predictions of recession, which didn't quite materialize as anticipated. So now, as we enter 2024, can you talk us through what is our assessment of recession risk here in the U.S.?
Sure thing, Michelle. So I guess to start off with, the important thing is when it comes to forecasting recessions, it's always important for us to be a little bit humble. Recessions are very difficult things to forecast. And as much as economists and strategists like to build complex models, ultimately we have a lot of uncertainty when it comes to how the economy is going to evolve. And so that's why it's important for us to really focus in on the data, to keep on learning from the data and revise our assessments as needed. So you might remember that in our 2024 Global Market Outlook, which was published at the beginning of December, we articulated the view that we thought a recession in the US would be more likely than not on a 12 to 18 month horizon. And that was our best thinking at the time. Since then, we've had a couple of important developments, the main one being at the December FOMC meeting, Chair Powell emphasized that the risks have become increasingly two-sided, and he talked about the notion of cutting interest rates in 2024. So that is a clear shift in the sentiment of the Federal Reserve, where before they were very much squarely focused on fighting inflation, whereas now, given all the progress they've made to date in fighting inflation, they can turn their attention a little bit towards also making sure that they're going to keep on bringing inflation back down to target, but at the same time acknowledging that they don't want to let the U.S. economy slip into recession. So it's really against this backdrop of the economy being more resilient than what a lot of forecasters were expecting, the Federal Reserve pivoting towards a more dovish stance, that we've decided to lower our recession probability from 55% down to 45%. Mm-hmm. Now, before everyone gets too excited and starts thinking that's good news, let me also remind you of a couple of important facts. One is that 45% number is still much higher than what we call the unconditional probability of a recession, meaning that in any given year, if you were to know nothing about the economy, you would probably say that the probability of recession in the US is around 15 to 20%. So 45 is still significantly higher than that, meaning even though we've lowered our probability of recession somewhat, we still think that there are elevated recession risks in the US and that investors need to be mindful of those risks. If you look at, for example, some of the credit card data, you see that delinquency rates are now exceeding pre-pandemic levels, showing that there is some level of strain being put on certain consumers. And of course, even though we've seen relatively painless progress to date when it comes to the Fed's inflation fight, the last and final stretch of that inflation fight can be the most challenging. So that's why we think it's important to really take a step back and to say, yes, we are lowering our recession probability, but it still remains higher than average. And the other important thing to consider is, well, how does that translate onto the market views, right? Look where the S&P 500 is. The S&P 500 right now is around 4,700, 4,800. When we look at where analysts are expecting the S&P 500 to end by the end of 2024, a lot of them are saying that the S&P 500 could end 2024 at around 4,800. So what that tells us is that not a lot of recession risk is being priced into the market. So we would argue that our 45% probability of recession is higher than that that's currently being priced in by the equity markets. And so because of that, we would be very, very hesitant about celebrating too early. We wouldn't want to chase into any short-term equity market rallies. Instead, we still think it's better to be disciplined, stay calm, and really try to stay close to your strategic asset allocation.
Mm-hmm. So you talked about recession risk in the US. How about recession risk globally?
Sure. So there's really two ways to approach this issue. One is to remember that we are in a very interconnected world, right? So what happens in the US affects Europe, affects Asia, affects the UK, affects Canada. So the fact that we've lowered our US recession probability is a slight positive for our outlook in the rest of the world. But at the end of the day, when you look at what is the recession probability in the other countries, it's not just the probability of a spillover recession, it's also these idiosyncratic factors that are specific to each country as well. So let's go through a few examples. Canada, the economic data in Canada has been significantly weaker than the economic data in the US. At the same time, the Bank of Canada's preferred core inflation measure is slightly higher than the Federal Reserve's preferred core inflation measure. So when you look at the totality of the economic environment in Canada, we would say that the probability of a recession in Canada continues to remain more likely than not, whereas for the US, we've now lowered our probability of recession so that it's not necessarily the most likely outcome. If we look at Europe, you look at some of the leading economic indicators like the PMI data in Europe, those are already showing significant signs of weakness. So we would argue that recession risks in Europe are still pretty elevated as well. So it's really making sure when you're looking at recession risks across countries, you, number one, think about the interconnectedness. So what are the implications of the US probability onto those non-US probabilities? But then also, two, considering the local growth, inflation, and central bank policy dynamics of the country that you're assessing in order to be able to try to come up with a well-reasoned view of recession risks. And once again, I have to emphasize that there's an incredible amount of uncertainty that goes into economic forecasting. We make our best judgment based on all the available data, but at the end of the day, there's a lot of economic uncertainty, and that's why it's really important for investors to stay disciplined.
Coming back to the US, can you walk us through some of the results that we had with non-farm payroll data as well as CPI results? And maybe you can tie all those numbers and talk us through the implications for the upcoming Federal Reserve meeting at the end of January.
Yeah, sure. So going back to a point I made earlier, Chair Powell was fairly clear in his remarks in the December FOMC meeting that the Federal Reserve thinks they're done with rate hikes. And so when we look at the data that we got, both in terms of non-farm payrolls and the inflation data, they weren't substantial enough to move the needle away from that idea that the Federal Reserve is likely done with rate hikes. So we think the Fed will be on hold at the January meeting. Mm-hmm. When you dig into those numbers, there's a couple of important details there. One, on the non-farm payrolls, job creation was somewhat stronger than expected in the month of December. When you look at the decomposition, much of that job creation was being driven by the so-called catch-up sectors, so healthcare, leisure and hospitality, education. These are sectors where total employment is below the pre-pandemic levels. But you did also see a slight broadening of the job creation into a few other sectors as well. So, for example, construction also saw an increase in job creation in the month of December. So on net, what we want to see, or what the Fed wants to see as the months continue into 2024, is they want to see the labor market continue to come better into balance. And that means they want to see job creation not necessarily be as strong, but they would also want to see that the job creation is a little bit broad-based rather than necessarily being concentrated in a few particular sectors. Mm-hmm. When you look at the inflation data, core inflation on a year-over-year basis came in at 3.9%, slightly hotter than the estimate of 3.8% from consensus. And ultimately, both of those signals remind us that, yes, the Fed has done a lot of great work, but this is not the time to declare victory. There is still room to go when it comes to the inflation fight. And that's why the Federal Reserve has to be attentive. And that's why we as investors have to be attentive, right? We always need to look at the data. As investors, it's very easy to get excited about things. It's very easy to panic about things. Mm-hmm. What we don't want to do is succumb to our emotions. We need to stay calm, stay disciplined. Look, I know with the Iowa caucuses coming up, a lot of people are going to be talking about the presidential elections. I'm obviously not running for president of the U.S., by the way. I can't even run. I'm Canadian. But if I were to run, my campaign slogan would be stay disciplined, because I think that's the most important thing for any investor to do.
Well, it sounds like the message for this week is stay calm and stay disciplined. Well, thank you for joining us and thank you for sharing your insights. And we'll be back next week.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.